Showtime. Is that a new hairstyle you have, Jane? It looks beautiful.
Okay. All right. Hello, everyone, and welcome to the 100 Black Men Las Vegas Youth Empowerment Economic Club. And we're here today with our partners, Wells Fargo, and this is class number 5 for the high school session of the Wells Fargo Hands-On Banking Program. I'd like to introduce to you today our partners, Ms. Jane Pavitt from Wells Fargo. She is the Vice President of the West Coast area. Say hello, Jane.
Good morning.
And we also have Mr. Alexander Nelson. He is a branch manager in his Neeson. Mr. Alexander Neeson is a branch manager and he loves the banking business. Say hi, Mr. Neeson.
Mr. Nelson, hi, I'm Alexander, okay. You guys.
Now, from the 100 side, we have our Economic Development Chair, Mr. Clifton Hines. Hi, Mr. Hines.
Good morning. How are you guys doing this morning?
Super fantastic. Okay, I will let you all take it away.
Fantastic. Mr. Hines, did you have anything that you'd like to say first before we get into the lesson?
I like to say that we're doing a fantastic job. Looking forward to these classes on Saturday, and I believe they're very effective, and I hope everyone's enjoying the information and taking full advantage of this opportunity.
Yeah, absolutely. Thank you so much. We appreciate your involvement, your support, because I think you definitely can bring some real world experience to the topics we talk about. So it's great to have you on the call.
Thanks for having me.
Yes. So good morning to the students. Good to see your photos. I know last week we talked about in our previous lesson, we talked about saving and investing and building wealth, and how it's important to have a savings plan and to pay yourself first. And then when we talked about investing and building wealth, we talked about the different vehicles that you could use when you're investing. So I just wanted to bring up last week's lesson to see if anybody had any questions. And for the students online, I don't know, Alex, can you see the chat, Alexander?
Let me see.
On your device, because I can't see the chat.
Yes, actually, I just see, I don't think we have any messages yet in the chat, but I can see the chat.
Okay, so if you guys have any questions, just take yourself off mute or put it in the chat and we'll get to them. But just wanted to pause really quick before Alex dives into the lesson. Okay, so Alex, why don't you introduce yourself a little bit, tell the students about how you got to where you're at. And one reason we like to highlight this is because you guys are all getting close to graduating from high school, and maybe you've already got a job, but maybe you're thinking about what's the next job that you want to do. And so, always think about coming to work at a bank. We're building your foundation right now with your financial knowledge for personally and for you and your family, but also when we talk about our different jobs at the bank, that might be something that you'd like to do in the future too.
Yeah, absolutely. So just to let you guys know, I was probably around either the same age. I started with my career in banking at 17. I really wasn't even anticipating as a senior in high school, even wanting to, or even a thought of, okay, I'm going to be a banker or working at a bank. And so I told this story a couple classes ago where my dad said, hey, this summer job, you build up as much money in your savings as you can, and I'll help match that to go ahead and get a car. And so at the time I was only working at, I think I was working at Best Buy at that time. And so I was only part-time. So I was making a little bit of money, but I was introduced to a manager. I was just going in and cashing my check, and she said, hey, would you ever like working at a bank? And I was like, how much do you guys pay? Because as a teenager, this is my first thing. So I started my journey in banking as, just like I said, part-time teller, senior in high school. And now I am 14 and a half, almost 15 years later, I'm working as a branch relationship manager where I manage small business customers, and I also take care of consumer clients as needed. So it has been an amazing experience just working in banking, and it's just one of those things that you will experience. I can tell you, when you're leaving from high school and you're going and transitioning into college or going into any trade school, something like that, you may think that you have one thing in mind until you may find that you have creative endeavors in other areas, and it just so happened that mine was finance. So yeah, I love it.
Thanks so much for sharing that, Alexander. I'm going to go ahead and share my screen and go into the lesson. Okay. There you go. You can see the lesson, correct?
Yep. Let's see.
Okay. You want me to go ahead and start the first?
Yeah, let's go ahead and do that.
Okay.
When my friend's car broke down, I loaned him $300. Then my friend, the car, and the money all drove away, never to be seen again. A total disaster. But it did teach me a very important thing about lending: trust. You see, lenders will loan you money if they can trust you to pay them back. We'll show you how to earn the trust of banks and credit card companies so you can establish and build good credit. That way you have the flexibility to borrow money when you need it.
So give yourself credit. So with that, what we're gonna do is we're gonna test the knowledge of what we know as far as this video. So testing what you know about credit by taking this quick quiz. We're gonna drag each terms to the correct definition on the right. So with revolving credit, who can tell us what area the revolving credit should go to, on which matching side? So when we think about revolving credit,
You can take yourself off mute or put it in the chat. And would it be helpful for me to read the definitions over here?
yeah,
Okay. So the first one is the ability to borrow money when you need it. A loan repaid in equal amounts over a fixed period of time. Numerical rating lenders use to make loan approval decisions. And the total cost of credit expressed as a yearly rate. So when you think about revolving credit, which one of those definitions would that fit? Any ideas? Anything in the chat? Alexander?
I don't see anything in.
Alexander, can you hear us? Or is it my computer?
Yeah, I don't have any. I don't have anyone in the chat answering.
Okay.
So we can just go ahead, and the ability to borrow money when we need it. Could it be that?
Let's try that. Let's try that. And
Oh,
then
we have James who says he thinks that it could be possibly the third one, James. You want to give it a try on the third one? James says he thinks it could be the third one.
Okay, so I put that down there, the third one. What about installment credit? Would that be the ability to borrow money when you need it? A loan repaid in equal amounts over a fixed period of time? Or the total cost of credit expressed as a yearly rate? Anything in the chat, or just take yourself off mute?
Okay. So we have James who replied, a loan repaid.
Perfect. Okay. APR, annual percentage rate. And we kind of talked about this when we did the savings lesson, and it was APY, annual percentage yield. So this is a rate. So would that be the ability to borrow money when you need it, or the total cost of credit expressed as a yearly rate?
And just to give you guys a little hint, the first word, annual, helps you with this answer. because annual can also mean something else.
Anything in the chat?
We don't have anything in the chat.
Okay. I may have to just do it myself then, maybe.
So we're gonna go ahead and we'll help you guys. So the APR is gonna be the total
Cost of credit expressed as a yearly rate.
So when
And
we
we'll put
think
credits.
annual equals yearly.
All right, so let's submit our answers. Looks like we got 2 of them right and 2 of them. So you know what I'm gonna do, maybe? Whoops. Our computer, it's definitely a
So
Saturday.
what we will do is we will move up the revolving credit up to the ability to borrow money when you
And we had that
need
one.
it.
Yeah, and then we had this one there. An installment credit there. Okay.
Mhm.
Good job. There you go. So revolving credit is
Very
the
good.
ability to borrow
Anyone
money.
have any questions?
Hmm?
Well, I was asking if anyone had any questions as to the reason why those went, if you understand the terminology and why the answers were incorrect in the beginning. Okay, it doesn't look like we have any questions in the chat.
Okay, I think we're gonna go through all this in the coming up lessons. So do you want me to move on to the next piece?
Oh, okay, yes, let's go ahead and go. I'm sorry, froze for a little bit. Let's go ahead and go on to the next lesson. So we're gonna do the credit basics. We'll go ahead and play this video for you guys. So what is credit?
Credit means being able to borrow money from a lender with a promise to pay them back, usually in monthly payments. Car loans, student loans, credit cards, and home mortgages are all examples of credit.
The lender makes money by charging you an extra amount in interest and fees over and above the amount of the loan itself.
How much will borrowing money cost you? It mostly depends on 3 things: how much you borrow, called the principal, how long you take to pay the money back, known as the term,
And the interest rate you're being charged.
right, and lenders will only loan you money if they have trust and confidence that you're able to pay them back. Earning their trust is called establishing credit.
Every time you borrow money and keep your promise to pay it back, you strengthen your ability to borrow again the next time. That's called building a good credit record or a good credit history.
Using credit can help you reach your goals, but remember, credit has benefits and risks.
All right, so what is credit? So we want to see here in the video, we saw that some of the key concepts we have. Credit is the ability to borrow money. Establishing credit is about gaining the trust of lenders. Borrowing is the responsibility to repay your loans, interest, and fees. And so just to really just expand on that. So when you think of the loan and you think to yourself, well, I have a set payment, understanding that within that payment, you are going to have those calculated interest and fees. So that is why it's important to understand that those are additional items when borrowing money you really want to understand, okay? So the cost is going to depend on the interest rate and how long you take to repay. So typically when you are taking out loans from any financial institution, it's going to give you a time frame from typically anywhere from 12 months all the way up to, let's say, 5 to 6 years, just depending on the lender. Your goal is going to be to achieve a good credit history from building that loan. Now we're going to talk about, well, I'm sorry, before we go there, is there anyone who has any questions about the key concepts of what we're talking as far as building your credit? I want to make sure that there's no questions before we proceed. Okay, it doesn't look like. Okay, yeah.
I have a question.
Yeah.
So when you talk about a loan and that it's payment, interest, and fees. Can you give us a really simple example? Like if I borrowed $200 from the bank, and it's like if I get charged 5% interest and I have a year to pay it back, what does a typical loan look like when it's an installment loan?
Yeah, absolutely. One of the good things about when you are getting installment loans is that you get something called a pay history of what it's going to be. So you already understand your loan will be broken down. It'll show your payment. It'll show the interest rate of how much. So, I mean, if you do the math on that, right, you'll do 5%. In Jane's example, you would just do that times whatever the amount of the loan. So for example, you guys, let's say you took out a loan and it was for 12 months and it's a year. The way that you would figure that out is the bank will automatically calculate it for you, how much it's going to be on, let's just say $1,000, right? So you would do that times the percentage or the interest rate of what the bank is saying that it will be for that stated loan. And then it's spread out over the lifetime of that loan, okay? And so in most cases, you do have the ability to pay the loan prepaid, but that's something that you would want to talk with the bank about because there are sometimes something called prepayment penalties. So remember, you guys, I know that there was a course when we discussed making sure that we really look at those loans and also the disclosures before you're signing that, because you want to make sure that you understand all of the interests and the fees that are applicable for your particular loan.
Great. So even though you're borrowing, say $1,000, you may actually be paying back $1,500, an extra $500 on top of the 1,000, right?
Yeah, exactly. So that would be what it's calculated over. And so to Jane's point, exactly. And so to Jane's point, that's where you want to, when you're shopping around for your loans, you want to see where there are institutions that will not penalize you for paying off the loan early, because you could, if you wanted to, pay off that loan early. Let's to save yourself from paying all of that interest that could be accumulated throughout the duration of the time of that loan. So for example, let's say you guys did a loan and it was for 12 months. And you had it with an institution that did not have any prepayment penalties, and we know that it was 5%, like Jane's example. And let's say you wanted to pay it off in 7 months, right? We would just go ahead and, excuse me, and they would pay, and you would pay only for the interest that you would acquire throughout the duration of the loan. So it would just be up to you. You could definitely save yourself a lot of money by paying off the loan sooner than anticipated.
And any institution, financial institution, credit union, or bank, they're supposed to give you all that information in writing, and it's supposed to be very clear. So if something doesn't make sense, it's okay to ask questions, and you should ask questions so you know how much you're going to be paying back.
Ask questions.
Absolutely. Yeah, if I could just add to that.
Yeah.
Hi, everybody. Hi, Alexander. Hi, Jane. How are you?
Hi, good morning.
Good morning. I apologize for being a little late getting on the screen. And I got glare behind me, so I'm going to stop my video, but you guys will be able to hear me. One of the things, because many of you in class probably heard of this formula, principal times rate times time. And write this down. PRT, principal times rate times time. So what Mr. Alexander is talking about, Ms. Jane is talking about, your principal in this case may be $1,000. And if the loan institution is charging you 5%, you multiply the $1,000 times 5%, and the time is 1 year. So principal is 1,000, interest rate is 5%, and the time is 1 year. And correct me if my math is correct, and that comes out to $50. So at the end of the year, you would have to pay $1,050 $50. Now, one of the things that Mr. Alexander talked about was also included in that in some cases, I emphasize some cases, you gotta read your contract. Because when we look at credit cards, those interest rates are greater than 5% because people don't pay back. And I want you guys to understand, it's good to be a good person. Being a good person is first and foremost. If you borrow money, pay it back. That's what my grandfather said. So write that down, principal times rate times time, and you will always be able to figure out how much you'll have to pay back in a given year. And like Mr. Alexander said, if it's within months, just take that year and divide it by the appropriate months, like in this case, 7/12. All right?
Excellent. Thank you.
Thank you,
so
Mr.
much.
Alexander.
No,
Thank you, James.
Daryl, thank you so much for that example. That's actually one of the best, simplified ways to really understand if you want to go ahead and calculate. When we talked about looking at the loans prior to you, right? Always wanting to do your research. This is a very simple, easy formula that he shared that you could actually do yourself just to get about an estimate right before you actually go in for that.
So
For that. That was amazing.
Yes. Write that down.
Okay, so we're gonna go ahead. Yes, principal times rate times time.
Right. You kind of cut out there a little bit, Alexander.
Oh, I'm sorry.
But principal times rate times time. And Dr. Rayford also brought up a really important point about being a good person and honoring your word, because when you take out a loan or credit, you are basically, the bank or the financial institution is trusting you that you are going to pay it back. It would be just like if you were going to lend your friend $50 and say, okay, just pay this to me back in 2 months. You would expect your friend would do that. So kind of think of the bank as your friend lending you this money, and you say you're going to pay it back in 12 months or three years, then you need to do that. So that's a good reminder about being trusted and thinking about it that way when you take out credit. Sorry.
No, and that's good. I'm glad that Jane brought that point. I'll just close out that portion by saying, and also to really just the principle of that, when we talk about being a good person and doing and making sure that you are taking those loans and paying them on time, because all banks talk to each other, right? So what you guys don't want is to have it be a situation where you took out a loan at one bank, right? And you did not fulfill your promissory of paying these payments on time, so that if you did in the future need another financial institution, you don't want that institution to say, hey, well, unfortunately, we can't give you a loan here because you didn't fulfill your loan at ABC Bank before. I thought I would just add that part too. Okay, so we're gonna go ahead and jump into the credit versus risk. We're going to read the thoughts of regular people. All of these people have credit, but some of them have borrowed more than they can comfortably repay. So reading the thoughts of them, some of them being experiencing problems with credit, while on others are on the right track. So we're going to start with the first slide. So it says, having good credit made it easier for me to rent an apartment.
Sorry.
It's okay. Having a good credit is easier for me to get an apartment, get service from local utility companies when I moved in. Good credit also gives me the option of buying things now, like my sound system, cell phone, and paying the money back over time rather than having to wait.
Great. So Alexander, it sounds like when you have good credit, and you were talking about how the banks talk to each other, which they do that in a variety of ways, but the main way is with your credit score and your credit report. But it sounds like with that example is it impacts also when you go to rent an apartment and when you sign up for your water and your power and your gas, even your television services, your streaming services, and your cell phone. So having good credit is important for lots of different reasons, it sounds like.
Definitely, and all different channels.
Did any questions or any examples from you all about how maybe having good credit impacted you or someone you know? Or do you have any questions about any of this?
Anyone in the chat? Let's see, we have a couple people still on. Any questions? We have Andre James, we have Alvin James. Any questions? No? Okay.
We can go to the next one. We'll read through these pretty quickly.
All right, great. So when I got my first credit card, it was too easy to spend. I started overdoing it, spending a lot more than I would have spent in cash. Now it's a real struggle to pay it back. I had a few things late. So now I'm losing money on late fees too.
What are late fees, Alexander?
So with every credit card, when you sign up, you will have something that's called a grace period, which is going to differ just depending on, you know, what card and whatever the terms and conditions. But making sure that if you have, let's just use an easy example. If you know that your credit card bill is due every 15th of the month, and you just so happen to forget and you pay it on the 16th, whatever the fee is that's in that term and disclosure at that time is what you will be charged, you guys, on top of having to make the payment. And also, let's not forget the biggest one, which is the interest. So that's why it's extremely important to be able to have your savings plan in your budget. And then, of course, the number one rule that I believe I talked about on the last couple of sessions is we don't want to spend more than what we have, right? Or what we know that we can afford. Those are going to be great ways to avoid having to pay any kind of late fees. And then also the most important part is with the late fees, you don't want the late fee to be reported on your credit item, because we could look at that first example and see that things such as getting an apartment or a utility bill, they're able to access that credit report. What you don't want them to see is that this is an applicant who has troubles with paying their bills on time, okay? Because that could heavily impact not only the application, but in some cases, the fees to move in, right? It may not be a situation where they will decline you, but you may have to pay extra just as a security for that particular utility company or an apartment. Does that make sense, you guys? Does anybody have questions on that? I hope that wasn't too confusing. No?
Any questions? No? Okay.
Okay. Sorry, I have to move my chat box. Okay, there we go. So I don't want debt problems. So I follow two guidelines. I never let my credit card debt exceed 20% of my yearly net income. Plus, I keep my credit card debt low enough so that my required payments are no more than 10% of my monthly income.
So that's kind of to your comment about having a spending plan.
Absolutely.
Right. Okay.
I really messed up my credit because my credit rating is low. It's going to be tougher for me to get loans or credit the next time. If I'm able to borrow, I'll have to pay a higher interest rate. It's almost like I was talking before the slides were coming. You guys, this is to my point again. So if you're having those issues and you have things that are reported on the credit report, it does actually lower your score. And so again, it does not mean that you will not get the loan per se. You may still be able to achieve getting the loan, but you may be paying for a lot more for the loan than really what it's worth, to be honest. So really making sure that you're keeping those payments done on time. But we have the next one. I didn't make some loan payments and that really hurt my credit record. I missed out on an apartment and even got turned down for a job because of it.
So there are some jobs where they have to run a credit report.
Yes, just in case you guys didn't know that.
Please explain why the jobs look for full credit report.
You want to take it, Jane?
You guys want me to take it?
Well, I can add, so working for certain companies, and it might be because you're handling finances, and Dr. Rayford, you might have a different experience, but there are certain positions within the bank actually where, you know, they run your credit score, and it's because of the responsibilities that you might have, is my experience. But Dr. Rayford, you may have another one, or Alexander, you may have another example.
Oh, where are you going, Dr. Daryl?
Yeah. One of the reasons why jobs are now more so than before pulling credit report, because people do desperate things in desperate times. And as Ms. Jane stated, if you're in a financial institute, or if you are in a business where you are in access to cash, money, banking stuff, somebody may take their personal interest into account over the job and take money from the job to pay their personal interest. And they are, and it's not good. It's really not good that our society has gone to this, but things have evolved because people have abused the system. So now they pull the credit just to make sure that, hey, this person might not steal from us. I mean, as I stated, it's sad, but this is what we have evolved to.
Yeah.
Very, very good point, Daryl. And I just wanted to add on to that by saying that that also goes back to one of the main key concepts that we were talking about in today's lesson, which included character, right? That character is also a part of the credit report. I mean, you can tell a lot by that credit report. And I know that a lot of companies, to his point, not only require that for that specific position. I apologize for the background noise, you guys, my window's open. What I wanted to say to that as well is, if you were going to be in a position where you're managing money or even teaching about credit, you want to lead by example, right? You want to make sure that you also too understand this concept enough to be able to properly articulate this to your client or whomever it is, wherever you're working, to that customer.
Excellent.
So it looks like we have one more.
Yeah, let's read one more and then move on, because we've got a lot of information still to cover. So you want to go ahead? Do you want me to read this one?
Oh, I got it. So with good credit, it's easier for me to buy what I want when I want it. I have the financial flexibility, make major purchases that take more money than I have had on hand. I just bought a great car.
Excellent. All right.
All right, so we're gonna go ahead and do the good credit. So on this slide, we have good credit signs. So here's some very good bullet points that talk about good credit signs. Paying at least the minimum required payment, paying on time, never missing a payment, and staying within your credit limit. Now, the result of having these great practices and best practices are, it will make it easier to borrow money and no additional penalties. For bad credit, we have paying too little, paying too late, missing payments, and going over your credit limit, which can result in it making it more difficult for you to borrow money, as well as you losing money on late fees.
So Alexander, can I ask a question?
Absolutely.
Because you give loans to businesses, small businesses,
Ooh.
and you help them with their money. Sometimes sometimes things happen to people, right? A bad, especially like with COVID, some people weren't able to work.
Yes.
So is it okay to call the bank and let them know that you're having maybe something happen to see if they can help you out? Do you get phone calls like that, and what usually happens?
Absolutely. I think that was an amazing point to bring up, Jane, because I know that especially because when we endure things such as global pandemics where there are going to be a majority of the population affected, there are typically programs that a lot of people don't even know that the financial institutions can offer for relief. So if you know that you are going to anticipate that you may not be able to make, let's say, the full payment as just a good Samaritan on good faith, they have something called good faith at some institutions and places to where you can actually call them in advance and say, hey, I'm going to be a little bit late, or I'm going to be late. Do you guys have any kind of program or any assistance to where you can work with me? I'm really wanting to ensure that my credit remains intact. And you'd be pleasantly surprised as to how many companies now, especially during the pandemic, are offering these type of programs where they can help set up payment plans even for your payment, if that makes sense, just to ensure that you are at least paying something and that the bank knows that you are doing the best that you can. Why don't you utilize a program that we have in place? So, yes.
Thank you.
So we're going to move on to steps to establish your credit. All right, so bank accounts. So open your own bank account and manage them well. Don't overspend. Never spend more than what you have in your bank accounts. Gas, store credit card. Get a gas or store credit card. Always pay your bills on time. Small loan. Take out a small loan. Repay it monthly in full and on time. Secured credit card. Get a secured credit card linked to a savings account. Anyone have any questions on either of those steps as far as building your credit? Okay. We're going to move on to the 5 C's of credit. So the 5 C's of credit. How do lenders decide whether or not to loan you money? Many look at the 5 factors. So this is something that you guys definitely want to write down. It's very important. You don't have to write, of course, the definition, but the 5 C's, starting with character. We just talked about that earlier. So when lenders evaluate character, for example, how long have you lived at your current address? How long you've been in your current job? And whether you have a good record of paying your bills on time and in full. If you want a loan for your business, the lender may consider your experience and track record in your business and industry to evaluate how trustworthy you are to repay. Okay, any questions on character before I move on? Okay, so capacity. Capacity refers to considering your other debts and expenses when determining your ability to repay the loan. Creditors evaluate your debt to income ratio, that is how much you owe compared to how much you earn. The lower your ratio, the more confident creditors will be in your capacity to repay money you borrow. So if you guys have ever heard the term DTI, you'll hear that a lot in banking and when you're looking for loans, which is just the acronym for debt to income ratio, okay? Capital. So the capital refers to your net worth, the value of your assets minus your liabilities. In simple terms, how much you own, for example, car, real estate, cash, and investments, minus how much you owe. Then we have collateral. Collateral refers to any asset of a borrower, for example, a home that a lender has to right to take ownership of and use to pay the debt if the borrower is unable to make the loan payments as agreed. Some lenders may require guarantee in addition to collateral. A guarantee means that another person, a document promising to repay the loan if you can't. And sometimes you guys might hear that as it could be the term of a co-signer. So you may go to apply for something and you might be by yourself and they might say, hey, you need a co-signer. So this is when you may have to ask, a family member or a trusted source to help you acquire the loan that you're looking for. So then the last C we have is conditions. So lenders consider a number of outside circumstances that may affect the borrower's financial situation and ability to repay. For example, what's happening in the local economy? If the borrower is a business, the lender may evaluate the financial health of the borrower's industry, their local market, and competition. Some lenders develop their own loan decision scorecards using aspects of the 5 C's and other factors. Example, borrower's credit used versus credit available.
So that's a lot of information there, but it's kind of the basics of when you take out a loan or get a credit card or any of those things. So does Wells Fargo, when we look at, are these the 5 C's that we look at as well, depending on the type of credit the our customer's trying to get?
Absolutely. I can tell you as a business relationship manager that when we are processing any loans for business clients, a part of my job, you guys, is to understand that the consumer who is applying for their business understands that before we can lend for business, we do like to take a look at the consumer credit report first prior to making a decision, because, if you can't manage your personal credit correctly, then how can you manage your business? And then in the vice versa, right? We can see a great history that you have with managing your personal credit, then of course your loan, and again, that's not guaranteed, but what I'm saying is that the better that you want it to be on your credit report personally before investing and doing it for your business.
Thank you. So any questions in the chat? See Miss Rhonda's shaking her head.
No questions in the chat.
All right. So we're going to go ahead and move on to lesson 3, your credit score. So a credit score, Jane, if you can scroll up just a little. I just wanted to read that. Yeah. So we all understand. So again, just a reminder, your credit score is a numerical rating used by lenders in the loan approval decision. Your coach explains how your score is determined. So we'll watch this video.
Lenders always want to know the credit history of people who ask them for credit cards and loans. To find out, they turn to credit bureaus.
Credit bureaus keep track of almost everybody's credit history information. Things like how many credit cards you have and how much you owe, whether you pay your bills on time, where you work and how long you've worked there.
In addition to your credit history, almost all lenders look at your credit score. This is a number that indicates how reliable you are at paying back your debts. A computer program analyzes your entire credit history and generates a single number or score, usually ranging from 300 to 850. This score helps lenders decide if you're a good credit risk or not.
So I'm just wondering, Alexander, if we can ask the students if they have ever heard of the term credit score. So have for everybody on the phone, have you heard of credit score? You could put it in the chat, yes or no, or you could take your phone off, your computer off mute and just say, yes, I've heard of it, or no, I haven't.
Yeah, I have heard of it.
Oh, great. Thanks, Alvin. Is it something that you've heard a lot, or just heard about like at school or conversations with friends?
I've heard my mom say it before.
Okay.
Great.
You know, like
Thank
keep your credit score up, be
Yeah.
able to buy stuff like a house and stuff.
Yeah, absolutely. That's absolutely right. One of the important notes at the bottom of the video is to understand that there are the 3 largest credit bureaus in the United States are going to be Equifax, Experian, and TransUnion. And just to kind of clarify on that, depending on what institution you go or whatever place, each company is going to have their choice of which one of the 3 that they use. So understanding that checking all 3 of your credit reports to ensure that the accuracy is correct across the board, because you will see the scores fluctuate depending on the report. So Equifax may be a slightly higher or lower, and that's why getting yourself into the routine of regularly checking your credit is something that you want, because you don't want one report to show you at a lower score and then one at a higher score, all due to there being, discrepancies. So ensuring that you check that is a good best practice.
And let me just say this, your credit is extremely important. Let me give you a couple tips that I use. If you have a credit card and your bill is due on the 15th, pay it the day before, pay it on the 14th. Then that ensures that your payment is in on time. And the reason why I say that, and I say this every class, every bank does not do business on the same time. So we're on the West Coast. For example, Capital One. If you have a Capital One credit card and you live on the West Coast, you have to pay your bill by 3 p.m. because they're on East Coast time. So at 6 p.m. on the day your bill is due, if
And
you're
they're cut off
paid
at
by
8
6
p.m.
p.m. Eastern Standard Time, you're late. 6:01, 6:05, you're late. So that means that if you're going to pay it that same day, which is, you have to have it in on the West Coast by 3 o'clock. So then that's why I say pay it a day before, because I got in trouble like that. Like I was like a couple of minutes late because I was running home from work to get on my computer to pay it. And I was marked late for a month. So it looked like I was late for a month, and I wasn't. I was only 5 minutes late. So that's why I said, so that's what I did for myself. I just started paying a day early. Then that way the payment is there. Your credit is very important.
I just have to say that was an amazing example. I too, I have had that before, so I could attest to that. And I always, just to use as a follow-up, you guys, if you can, one of my main things in talking a lot with my business clients and consumer clients is setting things up like automatic payment, because of those, everyone has, these busy lives, and to her point, like, she just could have done it that day, but because it was a timing thing, having that set up automatically. When we talk about your savings budget and talking about creating your savings plan, you can do things to where you can set it up to where it's coming out automatically one day before. And that just takes one less thing off of your plate of you having to worry about, oh my gosh, I got to run in and pay the bill, right? So very good example. Thank you for sharing that with us. So we're going to move on to how your credit score can impact you.
Mr. Kurt would like to say something.
Oh, okay, absolutely.
Hello, everyone. We're at another event as well today. Hey, Jay. So yeah, I got another example on that. Just what I wanted to share. Take the, I think I said this last week, but it applies to this week also. Take the emotion and the effort out of things when it comes to either investing, saving, but then also paying your bills. So just like you said, Alex, you want to have things paid automatically prior to the due date, on the due date, whatever it may be. Great example. I'm transitioning between banking accounts and things like that. I totally forget to set up or reestablish my automatic payment. That one missed payment dropped my score almost 100 points. I was in the process of buying a house, moving states, and packing and everything. So I'm completely out of it, right? But that one misstep almost cost me a house, almost cost me a great interest rate. It almost ruined me, if I want to say it literally, right? Caused me a lot of stressful nights. Luckily, that creditor allowed me to write a letter, explain what happened, all those different things. That normally doesn't happen, okay? So that's why you want to make sure you take the emotion out of paying your bills. I like seeing my money in my account. That's my problem. I have plenty of money now to pay all my bills, but I like seeing it in my account, right?
Yeah.
So we want to make sure you take the emotion and the stress of paying your bills out of your hands. The easiest thing to do is to automatically have those things set up, have those payments come out on a regular basis, and you'll be all set. It's so much less stress. I lost so much hair, as you can see, from doing that myself. But that's all I wanted to say. I hope you guys are having a great day and paying attention. And thank you all so much for being here today. Take care.
Thank you for having us. Thank you so much for that.
Thank you. And one quick question. For the students on the call, I mean, learn from our examples. We're giving you this information and this the foundation for your financial knowledge, so you don't make the same mistakes that we've all made, because I think we've all kind of made these mistakes. And a question for you, Alexander.
Yeah.
Everyone gets a free copy of their credit report every year, which has their credit score, correct?
Absolutely. Websites like annualcreditreport.com. I mean, there's a couple of them, but absolutely. So everyone is entitled to one free copy of their report every year. So a lot of people don't know that, but you guys know that now today.
And we'll probably, I see the topics that were coming up, credit reports next. We'll probably get into that in just a couple minutes.
Yes. So we'll go on to how your credit score can impact. Did we already read those bullet points up, Jane? I want to make sure we're not. Yeah, so let's start here. So there's 7 factors on the list that affect your credit score. Number 1 is the ability to get a credit card, your ability to purchase a home, whether a landlord will rent you an apartment, the interest rate lenders are likely to offer you, the amount of insurance premiums, your ability to borrow money, and lastly, whether you get service from utility companies. All right, how you can impact your score. So there are different formulas used to calculate credit scores, but 5 actions can improve it, 5 will hurt it. So improve your score. Do these 5 things. Consistently pay your bills on time. Keep your credit card balances that are 70% or less of your spending limit. Only apply and open new credit accounts when you need them. Have high income relative to how much you owe. Have a good credit history for a long period of time.
So one thing I want to just mention really quick, Alexander, because a lot of the students, when you graduate from high school, turn 18, and go on to your next step, whether it's college or trade school or just working, you may start getting a lot of credit card offers, or maybe if you're on campus and you'll get a free t-shirt if you sign up for a credit card. You need to be really careful about that and really think about whether you actually need that credit card. So just be prepared for that. If you don't need it, I don't think the t-shirt's worth it, because the more inquiries you get on your credit report, the more accounts that you have open, that may impact your credit score negatively. And so I don't know, Alexander, if you have had similar
Yeah,
experiences.
absolutely. Absolutely. Even just being, you know, former student at UNLV, I remember those days, obviously pre-COVID, where, you know, it's your first day, or they'll have those different, and, you know, the Rebel Lobby, and, you know, ensuring that, you know, before, like to Jane's point, that, yeah, the t-shirt may be nice, but one of the best things you can always ask is, can I see the terms and agreement? That's something that should be always on hand. You have to remember and understand with the APR, we know that's the annual percentage rate that's charged on that. So you definitely want to do your research and look to see which credit card is going to be best fit for you and also the most affordable. Okay, so on slide 2, so we have lower your score. Don't do these 5 things unless you worsen it. So paying bills late, have credit card balances near your maximum spending limit, apply for new credit cards frequently, whether you need them or not, have a very brief credit history, exceed your credit card spending limit. No. Another way to help improve your credit score is to have a mix of revolving credit, which is credit cards, and installment loan credit, which is something like a car loan.
So any questions before we go into credit report? Any questions about the credit score?
Okay.
Okay.
So we will go on to lesson 4, which is your credit report. So in this scenario, it looks like we're going to be finding an error. So 2 months from now, I'm sorry about that. 2 months from now, Rachel plans to move out of her sister's house and rent an apartment of her own. She realizes that any potential landlord will probably review a copy of her credit report. So Rachel requests a free copy to review herself. As she studies the report, she sees that it contains a major error. It says that she's 120 days late in paying $1,275 to a national chain clothing store where she never has even shopped.
It's crazy. So this is what, I don't know if you guys can see it, it's kind of small, but this is an example of what a credit report looks like. And it'll have your personal information. Maybe in the next section, it'll have it larger, but it shows the different payment histories. So let's see. Oh, we've got a test. So a little quiz. Do you want me to read this, Alexander, or do you want to read? Okay. So given Rachel's situation, which decision do you think is best for her? So you guys get ready to put this in the chat, what you think's best. So it shows she's 120 days late in paying $1,275. She's never even shopped there. So what can she do? Number 1, don't worry about the error. The credit bureau will fix it. Meanwhile, she can explain it. Or 2, contact the manager of the local clothing store, ask for a letter to show potential landlords. Or 3, contact the credit bureau, which is the company that develops the credit reports. Contact the credit bureau immediately and contact the billing department of the clothing company. So would you guys recommend Rachel do number 1, 2, or 3? And you just need to put it in the chat or take yourself off mute and just shout out.
But we have AJ, he says it's number 3.
Number 3, okay, let's try that.
Thank you, AJ. And you are
correct.
Right.
Fantastic.
Very good. So it says, Rachel says, I've always worked hard to maintain a good credit history. So I'm glad I took action as soon as I saw the mistake. I called the credit bureau and filled out from the other website. I also called the national customer service for the store. It turns out they had my account confused with somebody else by the same name. Now everything's straightened out again. Great advice. Rachel took personal responsibility for correcting the error and took the action right away. Your suggestion helped her solve her problem and protect her good credit history.
Fantastic.
So we're going to watch your credit report.
The complete written version of your credit history is called your credit report. You should review your credit report at least once a year to check for errors or fraud. And it's a good idea to review it before making a big purchase like a house or a car.
Also, keep in mind that you give others permission to look at your credit report when you do things like fill out a credit card application or apply to rent an apartment.
That's right. Many landlords do a credit check to decide if they can count on you to pay your rent. And some lenders study your credit report to decide whether or not to offer you credit.
Last but not least, an employer might check your credit rating when you apply for a job. If you have a good credit score, it shows them that you're responsible and more likely to be responsible on the job.
All right. So credit report information. A credit report is a written history. Credit bureaus maintain data. You can request a credit report. Others can request a credit report from them, and then lenders and landlords use them. So we'll talk about how you can obtain your credit report. The Fair Credit Reporting Act allows you to receive one free copy of your credit report once a year from each of the 3 largest credit bureaus in the United States: Equifax, Experian, and TransUnion. To get a free credit report online, go to their jointly run site, annualcreditreport.com. I mentioned that earlier, so I was right about that. That's good. Be wary of the many websites that advertise free credit reports because many consumers get tricked into paying for the reports and services they don't really need. The only website providing your free annual credit report is annualcreditreport.com, run jointly by Equifax, Experian, and TransUnion. Now note, when you receive your report, check for mistakes in your name, social security number, former address, accounts you didn't open, and errors in your history. And I just want to sidebar Jane really quick on that and just tell from a banker who has underwriting experience, I can't tell you guys how many times there have been very simple like mistakes that have happened when, let's say, for example, you have the same name as your father and you're a junior, and let's say, you know, your dad is the senior, you guys have that same exact name, but the credit bureaus may have put, for example, your dad who did not pay his credit card payment month, and the credit bureaus may have had a discrepancy and put that on your credit report, all because you guys have the same exact name other than just the suffix, which would be the junior, the senior, the third, and so on. So that was an example I wanted to use because it is a common thing that we have seen before in the banking world. So
that's a great example. And I think Alexander's example combined with the one that we just saw, that's why it's so important to check your credit report at least once a year. And you might not have credit right now, but maybe your older siblings, your older sister, older brother, your mom, or your dad has some credit established, and maybe you would want to suggest that they check their free credit report to make sure that everything on there is accurate. And then you could actually see one in person as well. So yeah, annualcreditreport.com. Are there any questions about in the chat?
Okay, so we're going to show you guys an example of how to read your credit report. So let's see. So the first field here is your personal information about you. This is going to include your name, your current and previous address, social security number, date of birth, and other information to identify you is listed. The next one is going to be the public record information. In this area, you'll find any information that is listed about you in the records of local, state, or federal governments. The next is going to be collection agency account information. If you fail to pay back one of your creditors, they may hire a collection agency to contact you. This is a company that specializes in collecting money to pay off debts. Next is going to be the credit account information. So your credit history, this is a list of all places where you have credit or used to have credit. These are called your accounts. The credit history section is divided into 12 columns. If you fail to pay back one of the creditors, they may hire a collection agency to contact you. This is a company that specializes in collecting money to pay off debts.
Sorry about that. I hit the wrong button.
That's
So
okay.
we just talked about the credit account information, and then we'll get into what that section is right there.
Mhm. So our last one, you guys, so it's inquiries. The list of all the companies you have requested a copy of your credit report for their review.
So one thing about this, you guys all have access to you know how to find this information. You can always come back to it later. So you could actually share this with, like, again, your older siblings, your mom or your dad, and you could go through this and you know, look at their credit report. Or if you have credit yourself, you can do it, and this will help explain what everything is. Are there any questions about? Any questions in the chat?
It doesn't look like we have any questions in the chat, Jane. So we're gonna move to lesson 5, credit cards. So here's a scenario. So pay now or pay later. Ryan's been working to save money for school next fall. While he's at work, his motorcycle gets clipped by a pickup truck and crashes over. The result, a bent foot peg, a broken lever, a smashed signal, and a scratched paint. It can all be fixed, but it isn't in his budget unless he pays some bills late. He needs his motorcycle to get to work and school. So, given his circumstances, you guys, and these 3 choices, how would you advise Ryan to pay this? Should he use his debit card and pay his other bills late? He needs to get to work and not take on debt. 2, use his credit card so he can get it fixed fast. Keep working and earn the money to pay it back. Or number 3, use the money he saved so far. Savings are for the unexpected emergencies like this. So you can either answer in the chat or you can take yourself off mute on which item you think that we should choose to help Ryan.
Okay, come on, someone pick an answer, pick an answer. Turn on your microphone and tell us which one you pick, A, B, or C.
Okay.
Anyone?
Or put it in the chat.
Okay, so put it in the chat. Which one do you think it is, A, B, or C?
Okay.
Everybody still thinking?
Everybody's still thinking. Okay, I'm gonna take a guess.
Well, Ms. Rhonda.
Okay.
Yeah, say, what would you guess?
I'm going to, let's see. I'm gonna pick number 3, number C.
Okay.
I am wrong.
Oh,
Okay.
incorrect. Take again. Oh, look,
Incorrect.
let's try this one.
All
Wow.
right.
All right.
Yeah, so it says that Ryan says, I'm careful about borrowing money, but I think it was a good time to do it. I figured out in advance how quickly I could pay off my credit card balance so that I could still pay my other bills on time and minimize the interest I paid. I also didn't have to clip into my savings and is that dip? I didn't have to dip into my savings that I've been working so hard to build up. Plus, I got my bike back right away and didn't miss work. Good advice. This was an emergency situation for Ryan. His loss of transportation meant he would be able to get to work and earn money. He was smart to get his motorcycle fixed right away, then pay off the charge as soon as possible. So it sounds like Ryan was very responsible with knowing how to manage not only his credit, but he was able to create a savings and budget to know that he was able to pay off that expense in the right amount of time. So great. The basics of credit cards. Here we go.
When you shop or pay the bills, how do you pay for things? Cash, debit card, maybe sometimes you use a credit card.
If you do, here's the important thing to remember. If you repay what you borrow over time, you'll be charged interest each month on the amount you still owe. So with a credit card, the total amount you end up spending on things may be quite a bit higher.
But if you pay off your purchases by paying your first credit card statement in full within the grace period, you'll pay no interest. Plus, you'll have your full credit limit available to use again.
And take it from us, once you have a card, it's very easy to use it. But to use credit cards the smart way, you need to know the basics of what they are and how they work.
All right, so we have the first one, applying for a card. When you apply for a credit card, the financial institution will check your credit history and decide whether or not to give you a card. They'll also decide how much you're allowed to borrow or charge. This is called your credit limit. How credit works. So every time you use your credit card, you're actually borrowing money from the financial institution that issued you the card. The financial institution pays the debt to the store for what you have bought. You then pay the money back to the financial institution. Remember, debit cards work differently. When you use a debit card at a store, you may have the option of selecting debit and entering your PIN, or credit and signing your name. Either way, the money is deducted from your checking account. Interest and interest rates. Interest is the amount of money paid by the borrower to a lender in exchange for the use of money for over a certain period of time. You can earn interest from a bank if you have a savings account, and you pay interest to a lender if you have the loan. The interest rate is the amount of interest paid per year divided by the principal amount, the amount loaned. Example, if you paid $500 in interest per year for a loan of $10,000, the interest rate is 500 divided by 10,000, or 5%. Does anyone have any questions on that breakdown on how to calculate that? Just want to make sure. Okay. So revolving credit. Credit cards are called revolving credit because as you pay the money back, your credit becomes available for you to use again and again. A second type of credit is installment credit. If you have any installment loan, you borrow the money and you just once and repay the lender in equal amounts over a fixed period of time.
So Alexander, so a revolving credit would be a credit card. Installment loans would be like for a car or a house.
Yeah, absolutely. So
and even your loans to businesses, are those installment loans?
We do have installment loans, and we also have credit cards. One of the best practices I always say with my clients is when you have a installment loan, your payments are going to be fixed. So remember, when you sign up for that loan, the institution is going to give you your pay schedule. So that pay schedule will show the fixed amount of payments for that duration of the loan. Whereas with revolving credit, you're paying only what you use and the minimum payment is going to depend on just how much of the credit is utilized on that card.
So are there any questions about the difference between the revolving and the installment? Anyone? You can ask it in the chat or take your phone off mute. Okay.
All right. So, all right, we got secured versus unsecured. A secured card is a credit card backed by a savings account. The money in the savings account is collateral, which means it may be claimed by the company issuing the card if the account holder fails to make the necessary payment. Using a secured credit card and paying according to the terms of the agreement can be a good first step for individuals or businesses that want to establish or rebuild their credit.
So a secured credit card is something that maybe when you're first starting out to establish your credit is something to look at and to ask your bank or your credit union or wherever you have your accounts to ask them about. Would that be, is that right, Alexander?
Yeah, absolutely. Far oftentimes than not, you'll see where people are asking for different methods, tools, and resources to be able to not only establish, but in some cases rebuild their credit. And so one of the things that the bank looks at is, if there's collateral involved, it may make them feel a lot more at ease with being able to give you, or I should say approve you for that specific credit product. Because again, to the point of the slide is that if you do not if you fail to make the payments, that collateral that you put up front, the bank will have the right pretty much to take that to pay it off, because remember, it was supposed to just be there to be put in place in the event that, that was to happen. So yeah. We're going to move to annual fee and finance. So some financial institutions charge an annual fee for their credit cards. This fee is the amount they charge a credit card holder to use the card for a year. The term finance charge means the amount of money a borrower pays to a lender for the privilege of borrowing money, including interest and the other service charges. The grace period is the length of time as defined in the card member agreement between the use of the credit to make a purchase and to start of the interest of the amount that's charged. So I know I spoke about that a little bit earlier, is that remember, it's going to depend on whatever financial institution that you are applying and getting your card from, making sure that you understand in that terms and agreement what day of the month. Some people think and they say, well, my credit card's just due next month. But remember, there's things called statement cycles as well as grace periods. So you want to make sure you check that to see how many days you do have, in fact, from the time of the purchase up until the bill is due, for you to not incur the interest, additional interest on that. So statements and email alerts. This is great. Every month, your credit card company will send you a monthly accounting document that lists all of the charges and payments you have made, finance charges, the total amount you owe, and the minimum due. Every time you use your card, every time you use your card, every month, your receipt, you compare your receipt to the statement. Many credit card companies let you check your transactions and make payments online and offer email alerts to let you know when you're close to your credit limit and the payment due date. Sorry, there's a little lag on the so I apologize for that. So pretty much, yeah, so signing up for alerts, we talked about that earlier, and that kind of can coincide with automatic payments. Those kind of things help. So note that credit cards can be more convenient than carrying cash, but remember, you always have to pay the money back. Lots of financial institutions offer credit cards. Shop around for a low interest rate.
So that's a lot of information that we just talked about. But the basics of owning a credit card, what the different types of, between like secured and unsecured, installment loans and revolving credit. So a lot of information. Does anyone have any questions, or any of the leaders, Dr. Rayford, Ms. Rhonda, Mr. Hines, anything that you want to add to any of this information?
No, I'm good.
Okay, so we'll go on to go low and repay fast. Credit card companies will send you a monthly bill or statement showing how much you've borrowed. This example shows how to save on interest. So let's say you purchase a new laptop for $500 with a credit card. Review this chart to see what you really pay when using a credit card with a higher interest rate and one with a lower interest rate. So it looks like here in the first box of the choices, we have a credit card number 1 with a $500 purchase. The interest rate is at 8%, pay within 6 months, and that total interest is $10.25, making the total price of the laptop $510.25. And then for credit card number 2 with the $500 purchase again, this time with an 18% interest rate, APR, paying within 24 months, the total interest is at $99, making the total price of the laptop $599.09. So it definitely pays to get a credit card with a low interest rate and to pay off your bill as quickly as you can. Why? If you pay off purchases by paying your first credit card statement in full, you'll pay no interest, plus you'll have a full credit limit available again to use. Note, annual percentage rate, APR, expresses the total cost of credit as a yearly rate, taking into account a loan's interest rate, terms, and fees. The lower the APR, the lower the total cost of borrowing. Killer credit tips. Want to avoid credit card nightmares? Your guide shares some awesome suggestions. So we're going to watch this video on killer credit card tips.
Most people spend more when they use credit cards instead of cash. So it can be easy to drown yourself with credit card debt before you know it. We don't want that to happen to you. Have a budget in mind before you spend, and don't spend what you can't pay back.
Remember, when you use your debit card, the money is deducted directly from your checking account. But with a credit card, you're borrowing the money. So again, before you charge, you need to think through how you're going to repay.
To keep your credit card spending under control, start out by selecting just one category to charge at first, like gas or groceries. Don't add a new category until you're sure that every month you can repay what you borrow.
Also, try keeping your credit card balance below 70% of your limit, and keep your credit card debt low enough so that your required payments are no more than 10% of your monthly income.
All right. So we're going to go to credit card best practices. So the first one here we have is looking for a low interest rate. Get a credit card with a low annual fee, low interest rate. Be sure to read your cardholder agreement. It spells out all the fees and finance charges. Call your card company's customer service number if you have any questions. Pay as much as you can. Always make at least the minimum payment each month, but pay as much as you can each month. Pay off the entire balance whenever you can. This will reduce the finance charges you pay. Be sure you can afford it. Don't use credit cards to buy things you really can't afford. Follow your spending plan and keep within your credit limit. Track your credit card charges throughout the month. If you stay within your credit limit, you'll avoid over-limit fees and damaging your credit rating. Try to keep your credit card balance below 70% of the limit at all times. This will help you build your credit by showing lenders that you can control how much credit you use, and it leaves enough credit available in case of an emergency. Paying on time. Pay your credit card bills on time. This is one of the best ways to build good credit because it shows lenders that you're reliable. It also helps you avoid late fees. Make sure you check your statement each month for the payment due date because it's not necessarily the same date every time. Avoid cash advances. Some credit card companies may offer you a cash advance. Avoid this option except in emergencies. You'll be charged a fee and the interest rate is usually much higher. Get Deb help early enough. DEB. That's interesting. Okay.
I think it's a typo because I think it's supposed to be get debt help
Get debt help early. Okay. If you're getting into trouble with debt, get help early. Contact your lender. Try to work out a repayment plan that works for both of you. You may also want to consider talking with a credit counselor, an experienced professional who can help you get out of debt. I know we went through that kind of quick. Make sure there's no questions. I think we're good.
Yeah.
Okay. So for the next section, we have how to read your credit card statement. Credit card statement formats vary, but they're always usually contain this kind of information. Your credit account number, remember to keep it secret or others can use your account. The closing date of the statement is the date of the credit card company created the statement. Number 3, the amount of credit line of your spending or your spending limit. Number 4, available credit is the amount of your credit that you haven't borrowed yet, so it's still available to you. Number 5, in the transaction section, you'll see a list each charge and payment you made in date order. Number 6, the number summary section summarizes your transactions. Number 7, your payment information shows the total amount you now owe, which is also called your new balance. Number 8, the minimum payment. Each month you must pay at least a portion of what you owe. If you wish, you may pay more than the minimum up to the total amount. If you want, you have good credit and reduce the amount of interest you'll pay. It's a good idea to pay minimum payment each month. Number 9, the due date. Unless your credit card company receives your monthly payment by this date, they will be charging you interest rate on top of amount you owe. Most companies will charge you a late fee. They may also increase your interest rate. Number 10, rate information shows how much the interest and fees are being calculated. And the last number 11, the payment coupon repeats your current payment information. Include this coupon with your check if you pay by mail, and be sure to write in your new address if you've moved. Remember, with a savings account, you earn interest. When you borrow, you pay interest. The interest rate a lender charges you depends on how good you believe your credit is, your credit worthiness.
So I just wanted to add a couple things right here. So it might be a good exercise to see if someone that in your household, or if you have one, has a statement that you can look back and compare all these notes with what's on the statement. But a lot of credit card payments now, you can make your payment online. And in fact, most people probably do that, but it still should have all of this information on your online account.
Right.
So whether it's paper statement or online, it should have all of this information. And so you might want to sit down after we get done with the lesson and go through one, and just so that you can actually see it for yourself. And so I don't know if anyone has any questions about this or any experiences they've had.
Okay.
See any in the chat?
We don't have anything in the chat, no.
Okay.
Okay, so we have credit card safety. So report loss or theft.
So maybe in the interest of time, Alexander, we just want to highlight instead of reading each one of them.
There we go.
Are you there?
I'm sorry, Jane. I couldn't hear you. What did you say?
Oh, I was saying, because the interest of time, maybe we should just read through these quickly.
I think so. Yes, Jane. Yep, that'd be fine.
So,
Okay. Alexander, can you hear? I think you're
that issue
frozen.
Oh, okay.
Okay, there you're back, Alexander. Do you want me to read through them?
Take the top, I'll take the bottom one.
Okay. So credit card safety. So your credit card, it's just like walking around. I mean, that's your financial assistance, your financial tool. So if you realize that you lost your credit card or maybe your wallet was stolen, report it immediately to the police and also to your credit card company. So first I would call a credit card company. They can stop any charges from being made and then report it to the police as well. And some companies will do that automatically. Make sure you sign your credit card. When you get your credit card in the mail, the first thing you need to do is sign the back of it. And that way, no one else, if they do happen to steal your card, most retailers should be checking the back of it. But sign your card right away and treat your credit card just like you have cash. So, you know, if you have a limit of $1,000, it's almost like you're walking around with $1,000 in your hand. So treat it really carefully and make sure you don't lose it. Alexander, did you want to do the next?
Especially keeping monitor your accounts and avoiding magnets.
So and avoiding magnets, is it because it makes the credit card maybe become inactive and you can't use it at the store?
Yeah, so if you ever have those situations where you're at a merchant and you're trying to use your card and you know that your card is working, but the strip that's on the back actually can get demagnetized. Sometimes you guys have heard the same thing. You go to a hotel and they tell you keep your hotel room key away from your phone, demagnetize. The same thing can happen.
Oh dear.
Yeah.
So Miss Rhonda, are we okay to keep going a little bit longer?
So yes, we are. Let's go over because loans are next. You want to finish up credit cards or go to loans?
Let's go to loans, I think.
Okay, so let's go to loans. Then we'll end on loans and then we'll recap next week.
Okay, that sounds good. Okay. So Alex,
Okay.
There you are. You're back.
For a loan. So Hudson wants to borrow $10,000 to buy a motor scooter at the lowest cost of credit while keeping his monthly payments under $400. Which of the three loans should Hudson choose? So we have a loan at 12.25% interest with a 24-month term. We have a loan at 14.50 interest with a 36-month term, and then a loan at 16.75% interest with a 48 term.
So I think we should just pick one unless,
So
is there any?
Yeah, okay.
So we'll go with the middle one. Ah, correct.
Yeah.
All right, so best choice. This is Hudson's best choice to get the loan with the 36-month term.
So Jane, so Alvin did pick number 2 in the chat. I just.
Oh, high five, Alvin. Good job. Fantastic. Good job.
Very good.
So where are we? So remember, the longer the term, the lower the monthly payments, but the higher the amount of interest over the life of the loan. Good job. Okay, how loans work.
Need money to pay for something big, like a car or college education? You may need a loan. Let's look at how loans work.
With a loan, you receive all the money the lender has approved for you in one lump sum. This is called the principal. Then, to pay the lender back, you need to make equal monthly payments, called installments, for a fixed period of time until the loan is paid off.
The lender may also charge you fees for giving you the loan. On top of repaying the principal, you'll also have to pay the lender interest.
How much interest you'll pay for your loan depends on three main factors: how much you're borrowing, the interest rate, and how long it'll take you to pay the money back. This is called the term of the loan.
All right, so comparing the terms, so we're going to check out this example. So the term comparison, so you can see that this is going to be based on a 10% annual percentage rate. In the column, so the term, we have loan A at 25 months, loan B is at 49 months. So let's take a look at the payment though, because in loan A, it's going to be 450 versus loan B at 250. Looking at the total cost of the loan in loan A column, it looks like it's going to be, what is that, $11,106. And then on loan B, it's $12,215. The total interest paid in loan A was $1,106 versus loan B, which was $2,215. So note that the final month's loan payment may vary from regular monthly payments. So lenders will often offer you options for the term. You might consider a longer term loan term to get a lower monthly payment than you can comfortably manage to pay.
Right, and this is where it's important with your spending plan. When your spending plan comes into play, is that you need to pick whichever option fits within your spending plan.
Yes. All right, and then we have comparing interest rates. So with the loan amount being at $10,000 with the 5-year term, as you can see, the interest is at 5% for loan A. Loan B, we have 15%. Now we're going to take a look at loan A's column. So that monthly payment is $188.77 versus loan B, which is $237.90. Now, the total interest over those 5 years for loan A is going to be $1,236.92, whereas loan B is $4,271.08. So as for the interest rate, it's important to shop around. Some lenders will, where did it go? Always try to get along with the lowest interest rate you can. Remember, a strong credit score may help you qualify for a lower interest rate.
So that's a really good example of how the difference in interest rates can really make you, can really reduce how much money you have at the end of when you're done paying it off.
Yes. All right. So we have loans step by step. Are we going? You want to continue?
Yeah, let's just read through the top of it and maybe do some highlights.
Okay, yep. So with the comparison shopping, obviously to make it easier, lenders are required to tell you the loan, so you'll know that up front. Number 2, choosing a responsible lender. This helps with doing your research. Always being careful when you're selecting a responsible lender can help you gain financial flexibility. Number 3, discussing the cost and the options with your lender before the fact. So making sure you're carefully studying those monthly payments and the APR. Understanding before you sign. So before you sign anything, make sure that you are reading your disclosures. Number 5, if you're unsure, don't sign. It's simple. And And then number 6, how long before they decide? It often takes a few days for a decision to be made about your loan application. However, a bank legally does have up to 30 days, you guys, to respond to your application. Warning number 1. Oh, go ahead.
Warning. Sorry, go ahead.
Warning number 1 of 9. So encouragement to include false information. If the lender has changed any of your income or expense information or leaves your income blank, do not sign that loan. Bank loan documents. Never sign a blank loan document or work with the lender who asks you to do something like that. Bait and switch tactics. When a lender makes promises in order to make the sale, but then backs out the promise after the sale. Make sure to avoid this. It's critical and carefully to read and understand the agreement before you sign. If you have any questions during the document, basically make sure that it's consistent with what you were told, and don't sign the agreement if anything in it is unclear or not promised. Okay, and this is equity stripping. Let's say you don't have much of monthly income, but you have built up equity in your home. If a lender encourages you to inflate your income on an application to help get the loan approved, watch out. A predatory lender doesn't care if you keep up with the monthly payments, because as soon as you can't, that lender will foreclose, taking your home and stripping you of your equity and that you have built, spending up over the years. Loan flipping is when a lender persuades a borrower to repeatedly refinance a loan, often with a short time frame, charging high points and fees each time. This is not in your best interest because it costs you money and postpones the loan principal from being reduced. A high fee for biweekly payment. Some lenders will offer you the option to pay your loan biweekly. Although this type of payment plan can reduce the finance charge and the length of the loan, predatory lenders may charge you $1,000 for the privilege of paying biweekly. In reality, such accounts can be set up for free or hundreds of dollars at most. Required deed signing. If you are behind on your mortgage payments, a predatory lender may offer to help find new financing. But the first, you are asked to deed your property over to the lender as a temporary measure to prevent foreclosure. But then promised loan never comes and you no longer own your home. Advertisement promising no credit, no problem. These are often warning signs of scams. Consumers responding to such ads are guided through a phony application process and may even receive fake loan approval documents. To receive the approved loan, they are told to pay money upfront fees or services, and instead end up losing money. And the last one is promise to refinance the loan to a better rate in the future. No one can make you that promise. Instead, ask what you can do now to get a better rate. If you're working with the local bank, for example, there may be a rate discount for making automatic monthly payments from your checking account. Balloon payments are large lump sum payments due at the end of the term. Before you sign a loan agreement that requires one, make sure you fully understand and are prepared to pay.
Yeah, so I mean, that was a lot of things to watch out for, but basically remember, if something sounds too good to be true, it usually is. Make sure you read and understand the documents that for whatever loan that you're going to get before you sign it. Don't ever sign a blank document. And if an organization, a financial institution asks you to sign a blank document, you probably just don't want to do business with that organization.
Right.
So yeah, Alexander, any other along those lines, any other, tips that you would?
My biggest thing of this is just read. I know that sometimes it can be a lot and it's like, oh, you're excited and you just want your loan, but it definitely takes time. It's worth it to take the time to really go through those terms and agreements with a fine-tooth comb, because you just don't want to be in an event where you're paying more for something than what it's really worth, really.
It's really good advice. And before we turn it back over to Ms. Rhonda, we went through a lot of information again today. So go back and read through whatever you don't understand. We'll wrap this up. We'll finish the lesson next week, and we'll wrap up with highlights next week as well. But we're also going to be talking about school and money next week. So it's kind of, it'll blend in nicely with that topic. Alexander, any other last minute comments before we turn it back over to Ms. Rhonda?
Nope, I'm just excited, and thanks for having me again this week.
If I may add to Mr. Alexander before we sign off, about reading documents. Many times we may feel like we're rushed in signing the document to get a deal. But what I found, I've implemented English 101. If every paragraph, the first sentence or two should be the subject matter of the paragraph, take your time and read each paragraph, the first two sentences. That'll give you a clue of what the paragraph is about. And if it's something where you need to read further, then take your time. Many times when a person is trying to make a deal with you and they see you reading the document, they will take a step back. Because a lot of people do not take the time to read. So take the time to read, as Mr. Alexander said. If you feel pressure, take the document home and read it. All right, everybody. God bless. I thank you, Rhonda.
Okay, Mr. Hines, you have any closing words? Okay, well, thanks everybody for joining us for Youth Economic Empowerment Club, Wells Fargo Hands-On Banking class number 5. This was a wealth of knowledge today, and I learned something new every day. It was good for me as well as the students. Students, thank you so much for your time and your attention, and we look forward to seeing you next week. On behalf of the 100 Black Men of Las Vegas, have a fantastic weekend. Bye-bye.
Bye.